Welcome to another edition of Pizz-Spectives. My name is Rob Pizzichetta, founder of Mont Wealth, and today we're going to talk about income in retirement. Now, I know we are all working towards building that base to get to a really big number in superannuation so we can retire comfortably, but there's also some people already in retirement thinking about some strategies on how they can support their income requirements. And today I have the pleasure of introducing Wilson O'Fee from Challenger, Senior Business Development Manager. Welcome, Wilson.
Thank you for having me.
Pleasure. I'm looking forward to this conversation. Now, before we do get started, as I always do, the general advice disclaimer. This is general advice only. Anyone acting on this advice without written and agreed consent from a financial advisor does so entirely at their own risk. So please go and seek financial advice. So now, Wilson, plenty going on in the market, especially around superannuation and aging population. So we've got plenty to talk about today. If we have a look at the agenda that we'll discuss today, obviously superannuation and retirement, we'll talk about the aging population and the landscape, talk a little bit about the risks in retirement, i.e. longevity. Now, it's a really good stat that you've got in this deck that I've already seen is what is important for retirees. So we can talk a little bit about that. How Challenger recommends portfolio and asset allocation. We'll talk through some case studies, some benefits, and then how Challenger supports advisors to prepare and plan for retirees. So now, Wilson, over to you.
Yeah, thank you. And thank you for having me. Retirement income, it's something that I'm speaking about day in, day out. And it's one that looks pretty different from the conversations I was having when I first joined Challenger. So I joined Challenger in 2017, and Challenger looked a little bit different at the time. And what we offered into market was a bit different. We had a very different rate environment, and the adoption of these these strategies in general looked different from what it was today. And so we get to this point in 2025 where retirement income is a bit more in vogue, and it's certainly a focus of the government and the focus of the regulator as they look to improve outcomes for retirees here in Australia. We've got the super system, which is really good, and it does a great job of growing people's wealth. But often we find that people get to retirement and they don't know what they don't know, and they can't, and they've got this pool of money and they don't always know what to do with it. And they go to seek a financial advisor to give them some advice. And I would say that lifetime income streams, given the history of them, are a little bit misunderstood. And as a result of that, the way that people have engaged with us has been very different, but things are changing. So in respect to what you just said, probably 4 things that I want to cover off today. And we'll definitely get to obviously what you said, but we'll look at how that retirement income landscape has changed. We'll look at the developments in the retirement space. I wanted to, as you said, touch on what retirees are telling us that they want. And then we'll look at an example, because I think it's always good to bring things home with an example.
Great.
That all sounds good?
Excellent.
Perfect. Okay. So I spent a lot of time talking a bit about how things have changed. And I said, it looks a lot different to what it was when I first started at Challenger in 2017. And I probably put down the changes and the adoption of lifetime income streams and the way that people treat retirement portfolios and down into these 3 areas. And this is where we really see the change. So I've got this big structural shift, and that comes from a few different areas. We've got client demand being pretty different to what it was and continues to change. And we're always trying to keep up with what that demand looks like so we can have a product suite that reflects what they're looking for. But then the environment's pretty different as well. As in 2017, we had a very different rate environment, inflation, what it was and what it is now. And so that lends itself to this story a little bit as well. I think structural changes is a pretty important one. You mentioned it. We've got an aging population. People are living longer. I think the stat that I saw most recently was that 1 million Australians intend to retire between 2025 and 2030. That's a massive wave of people entering retirement. And for a lot of those people, they have advisors and they'll seek advice, but for a lot of people, they won't. And so that represents, I think, a bit of a problem. And the government is looking to address that problem. If I think about the history of Challenger and the history of lifetime income streams, I think many people remember what they looked like in the olden days, if you want to call it that. Prior to 2004, lifetime income streams were 100% asset test exempt. Between 2004 and 2007, they were 50% asset test exempt, and then they lost their asset test exemptions. And so a lot of people stopped keeping up with what lifetime income streams were. But in 2019, the rules changed again, and we saw asset test exemptions come back. And that is a more of a phased approach. You get 40% asset test exempt up front on lifetime income streams, and that exemption grows in the back end to a 70% exemption. So this was step one in what was the government's plan to change the way that sort of people can adopt these lifetime income streams. In 2022, the retirement income covenant was changed. Is that something that you're fully across? I know we've mentioned, we've spoken a little bit about it, but are you fully across the income covenant?
Good to share that with the listeners. It'd be great.
Most recently, Treasury passed a consultation paper giving these super funds some guidance. It was a consultation paper that looked at the best practice principles. It said, you got to build these lifetime income streams. The retirement income covenant says you have to, but how does that actually work in practice? And so Challenger is doing a lot of work with those industry funds and platforms to build out what their solution looks like in retirement and what their solution for longevity is. And we've partnered with a number of those super funds. But that Treasury paper looks at what is best practice for you as a trustee, as the trustee of a super fund. And it says, well, if you're building a solution for retirement, what does it look like? And I think there's 3 points that they look to hit. It says your solutions or your offering has to help retirees have flexible access to their money. It says that they have to have a solution that maximizes the amount of income that they can receive in retirement. And it also says you need a solution that provides income for a lifetime or for the client's lifetime. Now, I think where we'll end up is that you want to build a balanced solution in the middle, one that gives clients access to capital, one that gives them as much income as possible, and one that tries to pay them for as long as possible. Now, account-based pensions obviously fit in there, and they're the lead solution for retirees and throughout retirement. They have so much choice around what goes into that account-based pension. They get the market exposure. It's got some prescribed drawdowns as far as how much income they have to take. But what it doesn't do, or what it might not do, is maximize the amount of income that they receive. Nor will it pay them forever, because the bucket, that's what an account-based pension ultimately is, and the components will look different for different clients, but it doesn't last a lifetime. Once you draw your income out of it, it's gone. And the solution that I think the government wants us to build, or wants the industry to have, is one that tries to balance all three. And that's where Challenger becomes, I think, a really important piece, because if you go with an account-based pension as the lead solution and you layer in something with a bit more guarantee, you are nailing all 3 points a little bit better than what you otherwise would. Now, it's not to say that these solutions are for everybody. It's certainly not the case, but there are a greater number of Australians that would find benefit from having a more blended solution. And clients, I think, don't really, they don't really care about what goes into all of this. Not true. They do care about what goes into it, but they're more concerned with the outcomes.
Yeah.
Can I live the life that I want? Do I have enough money to travel? Will it last me a long time? Because I don't know how long I'm going to live.
Mm-hmm.
So these modern solutions are designed to achieve all three of those things.
Wilson, can you just pause there for a moment and just explain exactly what a lifetime annuity is?
Yeah, of course. So a lifetime income stream, I think at its core, is a really simple proposition. A lifetime income stream is essentially a financial instrument where we'll trade some capital up front for the promise of income for the rest of your life. Now, essentially, that might be $100,000. It could be $200,000. Ultimately, it depends on the client. If you are willing to trade $100,000 and give that money to Challenger, we will make a promise to pay you for the entirety of your life.
Yeah.
There's also ways that you can structure it to index to CPI. There's ways that you can structure it to be market linked, so that you still get that market exposure on that income as well. It's got reversionary beneficiaries, and if something happens to you, then your spouse will continue to receive that income. It has access to capital across the journey. So if you get 5 years down the track and change your mind, you can pull out of the product. You are not locked into this thing.
And does the risk then lie with Challenger to invest that money to guarantee the returns for the investor?
It does. Yeah, absolutely. So Challenger is an APRA-regulated, superannuation-regulated insurance vehicle. So every dollar that gets invested with Challenger is invested into the Challenger statutory fund. And that statutory fund is overseen by APRA. And for every dollar that gets invested, we have to hold some regulatory capital in order for us to make good, in APRA's eyes, on the promise that we've made to the clients, which is to pay them income for a long time.
Yeah, got it. Right. All right. So we've spoken about the structural changes, the client demand, and obviously the environment that's changed since 2017. Now let's talk a little bit about some of the risks that people are seeing, or a biggest concern for retirees.
I think for financial advisors, this is pretty well understood. Maybe less so those who are not financial advisors, but there's the sector of what are the risks in retirement. And people often refer to retirement smile, but that is sequencing risk, market risk, inflation risk, longevity risk, and emotional risk. And sequencing risk and market risk go together. Obviously, we can't get an understanding of market risk, but for retirees to add into the pot, the idea of you get a few bad years in a row, a few years in a row, the results or performance or whatever it might be, that has a real impact on your portfolio going forward. Inflation risk also pretty, I think, understood, especially more recently with inflation running really hot. It's subside more than now. But that compounded inflation over the past handful of years has had a real impact on what retirees are spending. Longevity risk is a bit more misunderstood. How long is someone is going to live for? Obviously, we don't know. If you have a crystal ball, it's obviously a good sign, but we simply don't have one. And so we have to look at life expectancies to get an idea of how long we're going to live. Trouble with the standards that people will use or have been using the ABS life tables, and it's backwards looking data. So we really try to promote this idea of what does a modern life expectancy look like. We use the Australian Actuary to give us some of that data.
What are some of the things there, Wilson?
So this is longevity. So the idea, if you're a 67-year-old couple today, there's a percent chance that one of you will live to age 94.
Yeah.
So people will live to their late 80s. And of course, the ABS life tables, that would seem true. But we know that if you remember a couple years into retirement, you have that partner as you into that phase of your life, typically you will live longer. A couple life expectancies are longer. So there's a 50% chance one of you will live to age 94. By looking at that, there's a 50% chance you live well beyond 94 as well. So we're looking at that's for longevity today. I think more interestingly though, 12% of couples will need access to last past 100.
Yeah.
So if you're an advisor and you manage 100 client couples, 12 of those client couples are going to need money to last a long time. And if you've only planned to provide income up into the late 80s, there's going to be a shortfall. I guarantee that clients are going to want more than just a full age pension to spend. You will see that through the clients that you work with.
Yeah. Interesting. Okay, so that's longevity risk. And then what's important for retirees at the moment?
Yeah, so you've got this idea that the government is saying that industry funds and platforms need to look at providing these longevity solutions to their members. But that's not a different story to what clients actually tell us they want. And this was a bit of research from 2023, and it was from the National Seniors Australia, and they partnered with us to run this. We do it every couple of years or so. And basically what it does is it says pre-retirees and retirees, what's the most important thing to you in your retirement? And when I challenged, it was a state value for children. That was number one result from the survey, where today they tell us that the most important thing for them are regular income for essentials, income that's adjusted to inflation, access to savings when needed, money that lasts a lifetime, and then finally the ability to afford age care. Those are things that are rated most highly by pre-retirees and retirees today. It's the impact which you can see through that chart is still really important. However, maybe it's not the most important thing anymore. And so I think a couple of things that contribute to that, maybe it is things like early inheritances, people that have funded kids into homes early. And so a whole raft of things, but increasingly we find that Australians have a pool of money and they want it to last and they want to be able to spend it and they want to enjoy their retirement.
Yes. In fact, there's a better understanding that people are going to probably live longer. So they need capital to last the length of time. And obviously they're a bit spooked by the recent inflation data, which suggests that probably the power of money today is going to be worth less tomorrow. So yeah, there's obviously some concerns and people need to protect, but also grow their capital base to generate that income. So hence why a product like yours might be able to complement other things. So then talking about how it does it complement, did you want to talk a little bit about how the team there at Challenger thinks about how you structure a portfolio and asset allocation where you use your lifetime annuity income product as well as forms to complement and support income?
Yeah, absolutely. You look at it. Default for a lot of people today is the account-based pension, right? And account-based pension leads to really good outcomes in retirement. And 20 years ago, it wasn't account-based pension. Everyone had defined benefit income streams. So the landscape changed, and then this idea of 100% guaranteed outcomes to today, which is 100% flexible outcomes. and access to money. And account-based pensions have done a really good job meeting clients' goals through its time. And we're not saying to throw that out the window necessarily. What we're saying is that your account-based pension should still be the lead solution, but we could layer in something like a guaranteed lifetime income stream and help you to have flexible access. It would give you sustainability of your assets, and it will help you maximize income. And so when we look at what a blended solution looks like, we've got your growth in defensive assets inside your account-based pension or outside super, whichever one it might be. It's probably a combination. I would say, look, if you were to reallocate a portion of your defensive assets to a lifetime income stream, you might have better outcomes through retirement. And you've just diversified your assets through retirement, and we hope that's going to give you the outcomes that you're looking for. Now, if you're lucky to get an age pension, or maybe unlucky, depending on what you think, then most retirees are pretty, don't get the age pension as often. And depending on whether you get the age pension or not, we've got this thing with reallocate defensive assets to something that pays you guaranteed income. There's no volatility. It does what it says on the tin. It pays you indefinitely. That allows you to do more with your pension. It allows you to go high wage growth assets. And other than being a tool that has to be geared out to draw income out of consistently, you can hopefully gear it up to draw a little bit less income, hold more in growth assets, and provide improved estate outcomes, and maybe higher amounts of income over the journey as well. This is kind of a really basic illustration, but it's not unlike what I see happening across retail portfolios, mass affluent Australia, and into high net worth clients as well.
And have you got some case studies that can help highlight?
Always good to bring a case study. Now, they're really basic case study for today, Jen and Jim. And just to illustrate how this works, we've got this client, they're 67 years old. They've got 1.1 million in superannuation assets. Their balanced risk profile is 50-50 here. They've got 50 grand in the bank and 20 grand of non-financial assets. They want to spend 80 grand in their retirement. But they said, actually, I can't survive on anything less than $1,000 a week. And typical default type approach is account-based pension, right? And this is just from our time in Illustrator, and you talked about how Challenge can support advisors. We've got a really great tool called Challenge Retirement Illustrator. It takes 2 minutes to run and gives you an idea of whether a strategy that involves a lifetime income stream is appropriate or not. And it's black and white, it tells you whether it's good or not. But essentially what the main inputs from it is a direct comparison in the amount of income a client can draw. And so that's what the chart on the left-hand side shows. And it shows deterministic outcomes, which is fixed returns over the client's lifetime. And I have that account-based pension earning a 6% return year on year. Because if your account-based pension returns to 6% year on year, this is how long your money will last you. Now, the blue bars that you see on here is the client's age pension entitlement. And, they aren't eligible up front, but over time, they will become eligible and spending their $80,000. The light green bars that you see on the screen, that's the client's account-based pension drawdown. And the dark green is the client's cash that's returning. And then over time, they'll have to draw the rest to get up to 80 grand. But what this tells me is that they could draw under a 6% return, they could draw their 80 grand out to age 99, which a lot of people would look at that and they would say, fantastic, I've got to life, which is that red line, and income that run beyond that. At age 99, I've depleted my account-based pension and I'm relying on the full age pension. So I think most people look at this and say, hey, it's done its job. As I said, it's a contract to pay you income for the rest of your life, or you and your spouse's lifetime, but this is really how it works. And so it's got income that pays forever. You've got a death benefit that's 100% for the first half of your withdrawal period, and then a depreciating amount through the back end. And then you've got this access to capital, which is reducing from 100% down to over a withdrawal period. And that withdrawal period will be tied to the client's life expectancy per the 80 years life tables. So that's the product. But what is actually people with sort of more outcomes focused than they are income focused? And so at that point, we say, what if we did 80% to an pension and 20% to a lifetime income stream? So what we've done is we've laid in this lifetime income stream, and through that we've gone, hey, what does an 80% account-based pension weight look like, and a 20% allocation to a lifetime income stream? As I said, the account-based pension is still the lead solution here. And through this, you can see that graph on the left is fundamentally changed. You've got this light blue layer of income running through this portfolio now. And, what that's doing is it's reducing the drawdown on the account-based pension. And as we fast forward out to the point of at life expectancy where they'd otherwise run out of money, you see they can still have the ability to draw an income. Now, if you're alive at that point in time, obviously you've got the income to draw down off, but most people may have passed away by that stage. And the reason that's attractive is because if you're alive, you can draw an income, but if you've passed away, it probably means you have more money in your estate to pass to your kids. So not only is it giving you certainty around spending long-term and being able to draw an income long-term, but it's also potentially shoring up your estate value long-term. If I look at the charts through those dials on the right-hand side, I can see, hey, look, the chance of meeting $80,000 of total income jumps from 79 to 90%. So again, a bit more certainty there for the clients. And I think that's what they're looking for. Well, that's what they're telling us they're looking for anyway. Just to round out this case study, what we have here is an estate value model. And so you can see here the direct comparison between two portfolios. That blue line is the comprehensive or the blended portfolio, while the green lines are the ADP on its own portfolio. And early on, you will have an improved estate value through the strategy. Throughout those middle years, it's roughly identical, maybe a little bit down, but out towards life expectancy and beyond, we start to see those lines converge again. And so it's that people think if I allocate to a Challenger lifetime income stream, I will have less money to leave to my kids, when we find that's not actually true. And so what does that estate value actually look like? It's an improved estate value of about 100 grand at life expectancy. So if you're willing to allocate and blend your solutions, you've got about 100 grand more to leave to the kids come life expectancy.
And so that life expectancy is still around early 90s, is that right?
That was out to 94, that's right.
Yeah, 94, yeah.
So if you live beyond, those numbers only look more attractive. But yeah, I think when people see the outcomes as opposed to what goes into the portfolio and they see a more efficient portfolio through the retirement years, people are pretty happy to look at it or take it seriously as a portfolio application tool.
So just in summary then, what the Challenger lifetime annuity product does do, it helps. It complements the age-based pension, but it also complements superannuation balances to support and guarantee income, depending on whether it's market linked or CPI linked or however you want to manage that portfolio and longevity risk. It helps give certainty to investors that, hey, I'm going to get paid the income that I need, that I want for lifestyle needs, but then also desires. And then that way there's the possibility as well, as we get closer to unfortunate death, which is inevitable, that there's a prospect that the balance is greater than not for the estate and supports the legacy thereafter.
Yeah, absolutely. I think that's a really great summation.
Okay. Well, so Wilson, just for those that are listening now that want to get more information, where can they go to find that?
Yeah, the Challenger website has a whole bunch of tools and resources attached to it. We've got an advisor portal, which has calculators, tech articles, ways in which we can help you with marketing and so on. That calculator is probably the most powerful tool.
Great.
And I would encourage advisors who aren't using it to at least have a look at it. I'm more than happy to help step advisors through that.
Yeah, I've played around with it. I do recommend having a bit of a play around. Yeah. So Wilson, thank you so much for your time.
Thanks, Rob.